Hey guys, this is Andrew for tradingsenses.com, and in this video I want to talk about golden rule number 3, which is do not follow the herd. Let's get into it. So guys, for those who don't know me yet, my name is Andrew. Actually, Andrew is a nickname, but whatever. And I have already made 2 videos on golden rule number 1, which is to have a good, strict and proper risk management, and golden rule number 2, which is to have discipline, which is actually the only way to follow your risk management. So those are the very important rules that you guys should know, to be aware of. So I invite you guys to go to see those videos first if you haven't seen it yet. Now, golden rule number 3, do not follow the herd. What does it mean? It's very simple. It basically means do not listen to what people are saying around you. All right? Because nobody knows. I don't know. You don't know. We only think. But what I can tell you is that usually when people actually, don't do the effort to use some techniques, they don't work on, their views on what they really think the market would do. They just repeat what they hear. I don't know if you guys, know some people like this, but we all do. Those guys that, they pretend they think something, but they just heard it in the radio or on the TV or on the internet. They read it somewhere in the same morning, and they just repeat it like if it was their story, like if it was their view. All right. So they are ships, guys. They are ships, and they do not think. I'm not saying those guys can't think. I'm just saying that there are a lot of people that like to talk and are just talking things that they don't think personally. So do not listen to them. And another reason you should not listen to people around you is that, as I said, we are all humans. We have emotions. We have emotions, and our emotions, they are not random. I mean, the impact of our emotions on our view of the market is not random. It's actually making us think the wrong way. So if we get rid of our emotions, we are better. That's for sure. I'm going to show you a few examples why I think our emotions impact our view of the market negatively. I mean, that we usually should think the other way around. So for example, when we have a bull market, usually during the bull market, there are a lot of people that say, oh, it's too much extended, it's going too high. There is no good reasons for this bull market to happen, stuff like this. And this usually is the third wave. It's when the smart money is actually invested. Those are hedge funds getting in strongly, because it's actually the right time to buy during the third wave, because it's very impulsive, it's very surprising, but actually it's expected. And then you have the fourth wave, so correction, and then it goes higher again. And then those guys that were saying all the time, it can't go higher, then suddenly they change their mind. It's funny, but this is what is happening. And this is the fifth wave of Elliott wave formation. And by the way, for those who don't know what is Elliott wave principle, I invite you guys to click on the link in the description of the video, and you're going to receive a free video on where I explain everything, the best I can, about Ralph Ellison Elliott, who is just amazing. Whatever. So the fifth wave of Elliott wave formation is usually when you have the most greed. People are greedy, they see people around them making money, and they're just like feeling, why not me? Because usually those guys, they didn't buy the third wave, and they just, it's pure FOMO, fear of missing out. And they just see people making money and they want to be part of it. And then greed is coming, and they're all going to say, this is bullish. This market is bullish. Watch out, guys. This is usually when actually the bullish trend is about to be finished. All right. Fifth wave of Elliott wave formation. So basically the greed is making you fearless and bullish for bad reasons. We can see it the other way around, all right? When the market is dropping heavily, like really heavily, those are usually C wave of a zigzag or flat correction of Elliott wave principle. The C wave is usually devastating, is the most severe and hard correction that happens in those corrections. All right. And then what do you have? What is the feeling? Guys, what is the feeling? It's fear that is then transformed into some sort of panic. You don't think right. And everybody usually, you know, they're holding between the A wave. So zigzag is A, B, C. During the A wave, they're holding, you know, they're like, no, it's okay. It's just correcting like 10, 20%. It's going to come back higher as it always does. Then they have the B wave. All right. And once again, the B wave is the time to escape, guys, usually. And the C wave starts again. So it can be like 6 months, 6 months, 6 months. So, you know, 18 months of correction, like we had, for example, in 2008. And the C wave was actually expected, but still it surprised a lot of investors that thought the worst has been behind them. And actually the worst was coming. And what happens then? You know, you start to get the price starts to trade lower and you go below the bottom of wave A. Then how do you feel? You feel like, oh shit, I should have escaped when I could. But then you're like, all right, I'm in it, I stay in it. And then it goes lower. And then you have despair. You know, people are just desperated. And usually when the C wave is very long, you know, and it's just like ruining your mental, you know, you feel very bad. And your emotions are very going against the right decision you should take. And usually before the end of C wave, what happens? You have what we call capitulation. It's like too much, you know, you suffered too much. It's been too long, you're losing money. It's been too long. You could have get out of the trade. You are wiped out. If you don't have a proper stop loss and you are still in the trade, you are wiped out. You don't have a lot of money that is still here. But if it's a buy and hold strategy with no leverage, all right, you see guys that you're not going to sell. But if you have some leverage and you didn't put your stop loss properly, so we come back to golden rule number 1, put your stop loss where it should be, and depending on how much you can lose and invest, then usually you're gonna take the worst decision ever just before the end of C wave. You know, this is what is usually happening. You know, retail investors, they usually sell at this moment. Who is buying? Professionals, all right? Hedge funds, for example, because they know how things happen and they're going to buy massively and then the market is going to revert. This is what happened in 2009, guys. So just everything, I said all of this to explain to you guys that you should not listen to what is said around you, all right? Because of greed, because of panic, because of fear, because of all these emotions, people usually don't say good advice, all right? So stick to your plan and do not change anything because people just repeat what they heard. That's it for me for golden rule number 3. Do not follow the herd. I hope this helps you guys. And if it did, please like the video and hit the subscribe button. And stay close to shore. I see you guys.